So we start off property, plant and equipment, and the first thing I'm looking for, because we've got an overseas subsidiary, is our closing rate of exchange, which is 12 dinars to the dollar. So I add together Ribby and Hall, which gives me 370, and for Xi'an, 360 divided by 12 is 30. The investment in Hall is $98 million. We go to goodwill. Cost $98 million. And the cost at acquisition, i.e. the figure as originally stated, is $30 million. Financial assets, 15 for the group companies, and for the overseas subsidiary, divide by 12, that gives us 12.3. Current assets, 39 for the group companies, divide by 12, 10 for the overseas subsidiary. Ordinary shares, 60 for the parent company. For our investments, for Hall, $40. For Xi'an, 209 dinar. Other components of equity might need adjusting. 30 for the parent company. For Hall, $10 million. For Xi'an, 0. We have retained earnings, those of the parent. So for Ribby, directly to group reserves. For Hall, 80 at the SFP. For Xi'an, 300 at the SFP. Non-current liabilities, add them together, 95 for the parent and Hall. For Xi'an, it's 40 divided by 12 gives us 3.3. Current liabilities, 117 divide by 12 gives us 6 for Xi'an. So once you've set out your pro formas, can you see just how quick it is to get information into your answer sheet? We're now going to go through the extra information. At acquisition, in respect of Hall, OCE was 10 and retained earnings were 60. The fair value was 120. So our fair value adjustment is 10. Ribby acquired 60% of Xi'an for $330 million. So 330 million dinars. So we go to our goodwill calculation. When Xi'an's retained profits were 220. So we stick in a figure here of 220. The fair value was 495. Therefore, there is an adjustment of 66. The excess of fair values is due to an increase in land. So what we're going to do is we're going to increase PPE by 10 for Hall, and for Xi'an it's 66 million dinars, so I divide through by 12 and that gives me the figure to put through there. So that is Note A dealt with. Note B, the first part of the information in Note B is setting out that Xi'an has a different functional currency to that of the parent, and therefore its functional currency is the dinars, its presentation currency for group purposes would have to be the dollar. Xi'an has financed part of its operations through a $4 million loan from Hall. A loan is a monetary liability. This is from a... So here we've got the loan. How much have we borrowed? Well, we borrowed on the 1st of the 6th X7 4 million, and at that date there were 10 dinars to the dollar. Which is 40 million. $12 months later, we still owe $4 million, but now there are 12 dinars to the dollar. So what we have to do is that we credit the loan 8 million dinars and we debit reserves 8 million dinars. So what I'm going to do here is I'm going to credit non-current liabilities with 8 million dinars divided by 12. And when we go to Zian's net assets, currency loss on the loan reduces net assets by 8 million, reduces profits by 8 million. This is included in the financial assets of Hall and the non-current liabilities of Zian. What we're going to have to do, because it's intra-group, is reduce financial assets by 4 million and reduce non-current liabilities by 4 million, because you should not have intra-group balances in your consolidated accounts. That is note B. Ribby, who is the parent company, has an overseas asset. So we're going to apply the principles required there. Working number 7, we're looking at PPE. The cost on the 1st of June X7, it was 40 million dinars. At that date, there were 10 dinars to the dollar, which gives us a cost of $4 million. This is a non-monetary asset. However, we also have to charge depreciation. It's going to be 40 million times... We're depreciating it over 20 years. So the value, the carrying amount, is $3.8 million. And we're then told we have an impairment review Oh, sorry, it's 4 million. Yep. The impairment value is $36 million, and at the impairment date, at the SFP date, there are 12 dinars to the dollar, which means that our impaired value is 3. So what we're going to do here is credit PPE $0.8 million and debit group reserves $0.8 million. Yes. Yeah. So that gives an impairment of 0.8. So I'm going to reduce PPE by 0.8. No, because it's worth 4 million. 4 million divided by 20 gives 0.2. And we're going to debit group reserves by 0.8. So that's note C dealt with. Because it's in the books of the parent, and under the parent treats it as a non-monetary asset. But if there is an impairment, that's when you use the closing rate. Ribby owes $10 million to a third-party bank. It decided it would repay the loan early. So what I'm going to do here is I'm going to reduce non-current assets by 10 million and increase, non-current liabilities by 10 million and increase current liabilities by 10 million. We've got to pay an early repayment penalty of 1 million, so I'm going to increase liabilities by 1 million and reduce profits by 1 million. So all the time I'm thinking debit and credit. So if I'm paying a penalty, it's debit income statement, credit accruals, 1 million. If we're now going to pay off the loan early, it's going to be debit non-current liabilities, credit current liabilities, 10 million. For every debit, there must be a credit. Next, we have a bonus scheme. It's amazing what can arise in Section A. It's quite a complicated bonus scheme, but we've split it into two elements. First of all, there's a cash element. The bonus is 6 million, and we're going to pay 3 million of that in cash. So I'm going to increase liabilities by 3 million and debit reserves 3 million. When's that going to be paid? It's going to be paid on the 30th of November, so I'm going to increase current liabilities by 3 million and decrease group profits. So this is the bonus for cash from working 3 million. That should be. The other half will be given in share options. Now this is a little bit trickier. The options cost, it's going to be 3 million, but 10% of people are going to leave the scheme, so therefore 90% of people are going to be successful in the scheme, and the exercise price and the number of options will be fixed by management on the 30th of November. And so can you see that it's going to be an 18-month scheme, and we are 12 months through the 18 months of the scheme. So this gives us a cost of $1.8 million. So we debit income statement and also reserves with 1.8 million, and we would credit equity. I would normally take it to OCE in the equity section of my statement of financial position. So up to our profits, 1.8, bonus, shares from working number 8, OCE plus 1.8. Next, we've got a tricky part of a pension scheme. The rules for a pension is that if you improve the terms of a pension, if it's already been earned, then you charge it immediately to the income statement, and if it has not yet been earned, you charge it over the accrued period. So what does it say here? If you've worked for the company for 4 years, you're going to get more pension. So we've got an amount already earned in terms of the pension scheme is 3 million, and that is charged to the income statement. So debit income statement 3 million, credit pension liability 3 million. Because these people have already worked for us for 4 years, so therefore we can give them all that they're entitled to. Goes to non-current liabilities. Then we've got employees with less than 4 years service. These have worked an average of 2 years. So less than 4 years service, they accrue the pension rights over the service life. So what's this going to be? This is going to be $1 million, and they have worked for 2 years, but they've got to work for 4. You see that they're 2/4 of the way through, which works out as a cost of 0.5 million. So we would debit the income statement 0.5 million and credit the pension liability a further 0.5 million. The next one is quite tricky. We're considering selling a subsidiary prior to the year end. Hall sold inventory to Ribby for 6 million, which was in the books at 2, so it's made a profit of 4. That's intragroup profit. So the first thing I'm going to do profit in inventories, I'm going to reduce Hall's profits by 4 million, and I'm going to reduce inventories by 4 million in current assets. As a result, the bank overdraft of Hall was virtually eliminated. This was because we received the cash before the year end. So can you see that what we should really be doing is we should be increasing the overdraft, the negative cash balance of Hall, by 6 million, and we should be increasing the cash balance of the parent company by 6 million, because this transaction is what's known as window dressing. It's put through purely to make the books look better than they actually are. Now, we all know it takes place, but we're going to be ethical ACCA accountants and prevent it from taking place for the purposes of this question. We're then given some relevant exchange rates. Note L, lots of notes here. We've got the NCI measured at fair value. So for Hall, it's $42 million. So we've got NCI at acquisition. And for Xi'an, it's 220 million dinar. $220. Divide everything using the closing rate, gives us 18.3. We've therefore used every piece of information in the question in 20 minutes. What we've now got to do is tidy up. Always go to working number 2. So the net assets of Xi'an have increased by 79 million dinar. At the closing rate, that works out as $6.6 million. For Hall, it's $16 million. We can work out goodwill. Goodwill arises at the acquisition date, less net assets at acquisition. 120 million for Hall gives us a goodwill figure of 20 million. For Xi'an, net assets are 495 million. Which means that we've got goodwill of 55 million dinar. The cost of the investment, we're showing it at a figure of 30 million, but if we translate using the closing rate, it reduces the cost to 27.5. So therefore we would debit the income statement, or so we would debit group reserves with the movement of 2.5. The cost has fallen, so credit cost of investment, debit reserves, 2.5 million. That goes down to working number 5. Cost of investment, working number 3, 2.5 million decrease. If we work out goodwill as 55 million dinar, at the SFP date, all I have to do here is translate that using the closing rate of exchange of 12 dinar to the dollar, and that gives me a figure of 4.6 million. So I take that 4.6 million, I've got 20 for Hall and 4.6 million for Xi'an. Grand total 24.6. In terms of the NCI, we've got Hall since acquisition. Well, Hall has made profits of $16 million. Therefore, we give the NCI 16 million times 30%, which is 4.8. Who gets the other 70%? It's the group Hall since acquisition. 70% of 16 is 11.2. Xi'an since acquisition, $6.6 million worth of profits, and they are entitled to 40%, which works out as 2.6, and the other 60% belongs to the group. We can therefore tidy up these totals, and it gives us an NCI 67.7 and group reserves 122.6. I'm going to take those figures and transfer them up to the statement of financial position. NCI 67.7, group reserves 122.6, and we can carry on tidying up. Non-current liabilities, lots of adjustments to those, but if you add that up, it comes to 88.5. Current liabilities, add that up, comes to 143, giving us a grand total 513.6. Add up PPE, 414.7. Our financial assets are 23.3 and current assets are 51, 513.6. And that is our consolidated SFP.